Hello, everyone. This is Hunter Satterfield, one of the partners here at Kane Waters and Associates, and also the Chief Investment Officer and one of the members of the investment committee. As always, I am joined today by Brian Bortz, one of my fellow partners and the head of our investment committee, and then Brad Sanders, the managing director of Tectonic Advisors. Today, we'll be talking to you about your January market update. For the month of January, the S&P moved slightly up to the right at 1.7% up for the month. Global stocks were up right at 0.2%. Domestic bonds were down slightly at 0.3%, and global bonds were down at 1.4%. And we'll come to Brad here secondly to talk a little bit about what happened. But Brian, here we are in 2024. We've got a lot of geopolitical things going on. We also have an election cycle that we're nearing here at the end of the year as well. I wanted to come to you first to just sort of talk through with our clients a little bit about how we view years like this, election years, and sort of what we're thinking through at the investment committee for 2024.
Yeah, thanks, Hunter. You're right. This is an election year, and typically in the markets react favorably to an election year. There's a lot of anticipated hope, whether or not there's change or not, whether or not which political party is in power. It really historically doesn't tend to matter. An election year typically is a positive in the markets. That being said, I think that there are a lot of other factors that will also lead to this being a fairly positive year. We didn't have the anticipated recession that a lot of folks were worried with and were talking about. I know that from a technicals perspective, we went through all of those technical marks of a recession, 2 consecutive quarters of negative GDP, the market down by more than 20%. We did all of that stuff back in 22. And so no one admitted to the recession that actually happened technically, and they were worried about one coming, and it never did. And so now when you look at where our economy is, the economy is really, really strong right now. GDP growth is above average historically. We have a very strong economy. I think really what we're going to have to pay attention to in this election cycle is which side of the aisle tends to lead this thing and win, because we have a lot of major initiatives that are going to happen. Estate laws are going to probably change and things like that. So I do tell all of our clients to pay attention to what's happening right now, because whomever takes control for the next 4 years is really going to have a big voice in what happens economically in our country. So that's really what it is. And obviously, Brad's going to talk to us a little bit about the Fed, and I think that's going to matter as well.
Yeah, thanks, Brian. And I mean, I think again, for you as clients, the reality is that barring some major geopolitical, issue that we would see, I mean, broadly speaking, it should be a moderately good or bad. We don't really know, but it should be a decent year in the markets. And regardless of that, I think the key is continuing sort of remaining the focus on investing and long term, because no matter what, obviously long term will still be fine. Now, Brad, come over to you a little bit on the technical side to sort of talk through. Obviously, we've got some stability a little bit on the CPI prints that we've been seeing here more recently. The Fed has, talked quite a bit here over the past 3 to 4 months about what they're thinking for 2024 on rates. Do you want to talk a little bit about what you guys at Tectonic are thinking as far as cuts go for 2024 and the potential impacts?
Yeah, I think the Fed's the narrative for the first half of the year, and then to Brian's point, the election will kind of take over in the second half. I think we got some clarity yesterday. The Fed came out and made their statement and basically alluded to the fact that they don't think they're going to cut in March, and that's problematic. That's why the market sold off yesterday. We would have had a much nicer number to talk about at the start of this video, other than yesterday. Market's down over 2%. The Fed came out and said, hey, we may not get this cut in March. And that's problematic because the market's priced in 50 basis points of cuts by May. Okay, so if you look at the Fed funds futures, that's where market expectations are. So that's kind of what's in the market. That's why we got that huge jump in November and December. It's because the Fed said, hey, we are going to ease next year. And the market took the ball and ran and kind of priced this in. And so, it's pretty clear that the Fed's going to do cuts of the quarter point variety when they do start easing. And that's because we do have this inflation boogeyman. You don't want to be cutting too much too fast. So they're really going to ease their foot off the pedal instead of going whole hog unless something economically necessitates it. And so if you're not going to do a cut in March, that means it's really going to be hard to get those 50 basis points by May. And that's what the market has priced in. And so we're going to have this constant tug of war between Fed language. I'm sure some Fed governor will be on CNBC today and say something different, and the market will be really volatile. And, if we think back to last year, it's kind of how last year was. We ended up having a great year, but for most of the year, it didn't really feel like it. We were all over the place. I think 2023 or 2024, excuse me, could shape up the same way where, boy, it's a wild ride, but it ends up being a decent year. There's some things to watch, though. The market's priced in a soft landing. That's everybody's favorite buzzword. It reminds me of green shoots post 2009. Like, you couldn't turn the corner without somebody saying green shoots, and now you can't turn the corner without somebody saying soft landing. The problem is, historically, soft landings are really hard to navigate and actually, to kind of get there. We have some baked in slowness to the economy. We have some stuff rolling off from last year that's not going to be there this year. It doesn't mean we're going to go into recession territory. It just means that a lot of expectations may be a little bit too frothy. I think you're starting to see that in some of the numbers out of some of the Magnificent Seven. Google had some softness. Microsoft had some layoffs. Tesla had some softness. So I just think expectations might be way up here and reality's here. And it may take the market a while to ferret that out. And once we do, we'll kind of probably settle in to a nice tape where we can make some good returns this year, particularly it being an election year. But I do think the first half of the year is going to be marred by what's the Fed going to do? Oh, we're going to price this in. Oh, they didn't do it, until we kind of get to an area where they feel like they can actually ease. To your point, inflation looks good and is on the right trajectory. I think you're starting to see some disinflation in some prices in some areas, which would really help get that even lower. But with this geopolitical uncertainty, things like Iran and all this stuff going on overseas, you could get an oil spike that can kind of throw a wrench in the spokes. It doesn't mean that we're not going to get to where we're going. It just means that we might have had a circuitous path to get there. So yeah, I think kind of, you take how last year felt and kind of overlay it on this year, we can kind of expect more of the same. So that just kind of means stay invested, don't stare at it, don't let anything scare you away. And kind of the end is the goal. We'll get there. It just may not be the way we all want it to be on the way.
Yeah, thanks for that. And obviously, as they both mentioned, folks, we've got a lot this year. So we'll be in front of you at the end of February, all kinds of things with the Fed, with geopolitical issues, with inflation, and then also with the elections coming. So should be an interesting 2024, and we'll be back in front of you in a month. Thank you so much.